Here's a question you may have asked yourself recently. Why does my savings yield less than expected? Or why does the exchange rate feel off when I buy foreign currency? The answer may lie in something that sounds complicated but affects us all: central bank interest rate policies. In September, global central banks were anything but coordinated. Some rushed to cut rates to stimulate their economies. Others held rates steady, refusing to budge. On September 17th, the U.S. Federal Reserve cut rates by 25 basis points. The next day, the central banks of the UK, Japan, and the Eurozone all chose to keep their interest rates unchanged. This divergence is more than just a policy choice. It could reshape stock markets, currency movements, and even how your mutual fund performs. So what exactly happened, and how should you respond as an investor? Let's break it all down. Starting with the US. On September 17th, the Fed reduced its benchmark rate to a range of 4.00% to 4.25%. The interest rate on reserve balances, or IORB, also fell to 4.15%. Why did they make this move? One big reason is the job market. In August, the US economy added just 22,000 new jobs. That's well below expectations. In fact, updated data shows that employment growth in previous months may have been overstated. Job creation is slowing, and more Americans are finding it harder to get hired. Inflation, while still present, remains relatively stable. So the Fed is shifting its focus towards supporting employment. Analysts expect 1 or 2 more rate cuts before the year ends. What does this mean for investors? In general, lower rates reduce borrowing costs for both companies and consumers. That can support business expansion and encourage spending. For the market, it often means growth stocks like tech can perform well because their future earnings become more valuable when rates are low. If you're holding growth-oriented funds, this could be a positive tailwind. And if you're a conservative investor, now may be a good time to review your bond allocations, since rate cuts affect yields. Now let's look at the Eurozone. On September 11th, the European Central Bank left all 3 of its key interest rates unchanged. The deposit facility stayed at 2.00%, the main refinancing rate at 2.15%, and the marginal lending facility at 2.40%. This matched market expectations. Unlike the US, inflation in Europe is less of a concern. Consumer prices are fairly stable and close to target levels. But the issue here is growth. Economies like Germany and France are losing steam, and the broader Eurozone lacks momentum. Market analysts believe that the ECB could start cutting rates sometime in 2024, with a prolonged low-rate environment continuing into 2026. That would reduce borrowing costs and, over time, help businesses recover. What should investors consider? European equities may lag in the short term, but longer-term rate cuts could eventually boost earnings and support a rebound. If you invest in international stocks or funds, this is worth watching. Across the channel, the UK faces a more complex problem: stagflation. That means the economy is barely growing, while prices continue to rise. In July, the economy barely expanded. Over the past 3 and 6 months, growth averaged just 0.1% per month. Meanwhile, both headline and core inflation, which strips out volatile items like food and energy, continue to climb. On September 18th, the Bank of England voted 7-2 to keep its interest rate at 4.00%. The central bank is signaling caution. It wants to support growth, but inflation is not yet under control. So rather than aggressive cuts, the bank is expected to ease policy slowly over time. For investors, this means UK stocks may remain under pressure for a while. But once inflation moderates, a gradual rate cut cycle could help rekindle market confidence. Turning to Japan, we're seeing early signs of economic recovery. In Q2, GDP rose by 0.5% quarter over quarter, beating forecasts and improving on the flat growth seen in Q1. While inflation has cooled from its peak, it still exceeds the Bank of Japan's 2% target. Even though political uncertainty has grown following the Prime Minister's resignation, economic fundamentals are pointing in the right direction. On September 19th, the Bank of Japan voted 7-2 to keep its benchmark rate at 0.5%, and it also began gradually selling off its ETF and J-REIT holdings. Markets expect that the BOJ may soon pivot toward a more hawkish stance, possibly raising rates as early as October to manage inflation. what does this mean for currency investors? The yen could strengthen in the short term, especially if Japan begins tightening while others continue to cut. That could make yen-denominated assets more attractive. So what's the big picture? In September, the Fed cut rates while the ECB, Bank of England, and Bank of Japan all held steady. But over the next few months, most central banks, except Japan, are expected to cut rates further. In the US, continued rate cuts could support the stock market, particularly sectors like tech and consumer discretionary. Lower borrowing costs help companies expand and boost investor risk appetite. In the currency markets, the euro and pound are likely to stay relatively stable against the dollar, as all three central banks are on a similar path. But the yen is the outlier. With Japan possibly raising rates while others ease, it may gain strength in the near term. For investors, now is a good time to revisit your portfolio. Whether you invest in equities, bonds, or currencies, central bank policy is shaping the landscape in real time. If you found this video helpful, be sure to like, share, and subscribe, and leave a comment down below on what topics you'd like us to cover next. We'll see you in the next video.